Hello, everybody. Good morning, good afternoon. My name is Charlie Gipple, the owner of the Retirement Academy. Absolutely thrilled to be talking with you today. This is our very first webinar. And by the way, there's nobody better to kick us off than this speaker that we have here today. Hey, Heather, can you hear me okay?
I can hear you just fine.
Absolutely thrilled to have you. You know, I've been friends with Heather for a couple years now. She's an expert. You're going to find that she is one of the finest tools that we have in the retire. I didn't mean to say it
Yes,
that way,
I'm a
Heather,
tool.
okay?
I'm a tool.
She really is a great resource for us within the Retirement Academy. So absolutely thrilled to have her and absolutely thrilled to have you fine folks. We actually have a group here that's bifurcated. This first one, I have members as well as I opened it up to some non-members just to get a feel for the content that is the Retirement Academy. And the Retirement Academy, it's about education, training, and just furthering what it is we do in financial services. And we have a mixed group on the phone here. We have agents, we have independent marketing organizations that are members of the Retirement Academy, as well as, I don't think we have any carriers on this call, but we actually have carriers that are members of the Retirement Academy, so absolutely awesome. Now, what I like to do on the webinars is make sure that you can hear us and see us, because if we talk and if attendance starts going off, then that means that you probably can't hear us or see us. So down below where it says questions, in that questions pane, can you tell me if you can see me and hear me, as well as, most importantly, our main speaker, which is Heather. All right, so we have a couple coming in. Heather, it looks like our AV is good, which that doesn't always happen, so that's a good thing. All right, so everybody can hear us and see us. Now, housekeeping items. Number one, as we go here, that same way that you just responded to me down in the lower right-hand side, as we go through this webinar, ask questions. If we say something that didn't make sense, or maybe you have feedback, maybe you want to add some items down below on the lower right-hand side, do so as we go through the presentation. We actually are going to have a pretty good group. They're still logging in, so I'm not going to unmute the phones. I was going to originally, but that can be a slippery slope. Somebody puts us on hold, we're listening to elevator music, and it kills the entire presentation. So that's housekeeping number one, ask questions as we go. Number two, I've been told that the Retirement Academy has so much stuff, oceans of stuff, 300 videos, 70 different articles, that it's very easy to miss one thing or another. Just when it comes to navigation, it can be very easy to miss maybe 10 videos over here when you have 290 videos over here. So what I did, and I'm going to post to the Retirement Academy this afternoon, is a 10-minute video on how best to navigate through the Retirement Academy, because there's oceans of material. And if we don't get the navigation correct at the outset, then when there's 1,000 videos in there 2 years from now, it's going to be interesting, right? Another housekeeping item, Academy webinars. Pay attention to the webinars that we have forthcoming. We have folks like Heather, of course. These are subject matter industry-wide. It's not just Charlie likes these people. No, it is industry-wide experts here. Tom Hagna, we have him on the agenda. We have Bobby Samuelson, who's a life insurance actuary, effectively. He's one of the foremost, more technical guys when it comes to whole life insurance, IUL, and just talking about products, product development, loan arbitrage, you know, all of that fun, kind of geeky stuff that I love. Bobby Samuelson, Luke Cosme, an executive of one of the big whole life companies out there, Mutual Trust, and Luke is fabulous. You'll like him. Survey at the end. This is another housekeeping item. Stick around. Tell us what you think about the webinar. I like to not hide behind a cloak of formality, as I call it, as I give presentation training. And Heather and I were talking. She's like, should I put together a bunch of slides? I'm like, no, you are great. Just you. Me, well, you can be the judge of that. I don't know. But to not do it in such a formal manner, humans are humans, and humans many times hate formalities. But tell me if you like that style. Tell me how Heather did. Tell us what you think of the Retirement Academy thus far if you are a member. Last item here is speaking to the oceans of material that's in the Retirement Academy. Sometimes the order and how you ingest the material, the chronological order, is just as important as the material itself. But yet at the same time, when you look at all the wonderful stuff that's out there, it's like, okay, how do I know? Again, there's a lot, right? And I've gotten nothing but compliments, no complaints yet, fortunately. How does that chronological order, how can we force a chronological order if you choose to force yourself a chronological order? Courses are coming. And I think you'll like this. And think of this as a recruiting tool as well. If you're a financial professional or an IMO or a carrier for that matter, think of courses that are coming in addition to what we already have in the academy as being a training mechanism. As in, okay, here's a course on annuities 101. All right, what are annuities? Boom, you cannot move on until you complete that. The history of annuities, boom, you cannot move on until you complete that. Annuity specs, you cannot move on until you complete that. And testing at the end. That is courses. I think you're going to like that. So with that, those are the housekeeping items. I'm going to give Heather a appropriate introduction. Actually, before I go into her bio, just a few points on her bio. I'll tell you a little bit about the agenda of this call. It's really divided into 3 different sections. Number 1, we want to look backwards a little bit. So what I want to do is I want to ask Heather, hey, what has happened recently from a tax legislation that will serve as either an FYI or a reminder to our financial professionals within the Retirement Academy. And just as important, on that number 1 topic, what are the opportunities that exist given what has recently happened from a tax legislation standpoint? Number 2, more forward looking. What is on the docket? What's likely to happen going forward? And what are some future opportunities, as well as maybe present opportunities for financial professionals to talk with their clients that you should be leveraging? So number 1, backwards looking. Number 2, forward looking. And number 3, I asked Heather, I said, hey, give us your humble opinion, or maybe not so humble opinion, of what agents should be doing today, how they can make their practices better, what carriers should be doing today, in your opinion, and what IMOs should be doing today, given all of this tax information that we're going to talk about. So those are really the 3 different items in this presentation today. With that, I'm going to ask Heather a question here in a bit that's going to kick us off, but I want to start out by just kind of giving her the appropriate introduction. And I could sing your praises all day long, Heather, but instead I think a few bullet points here on your actual bio is important. First and foremost, Heather is the founder of HLS Retirement Consulting, which partners with financial, legal, and tax professionals to basically help you find folks, as well as the other professionals here, with stuff like what we're talking about today. Over 25 years of financial services experience. Heather, you must have been the smartest 3-year-old ever when you entered the business.
I was 2, yeah.
Yep, 2, I'm sorry. You were only 2. So 25 years of experience. She's a writer, a speaker, and a trainer on a nationwide level. She's the creator of Social Security Advisor. I will say this with confidence. There is nobody that compares to Heather industry-wide, especially when it comes to Social Security planning strategies. And for like $125 a year, you can subscribe to her Social Security Advisor newsletter. And when Heather talks, I'll make sure that she gives you how you can go about getting on that list, on that newsletter. If you're not talking about Social Security, 65 million consumers say that you should be talking about Social Security. She's also, some of you may have heard of this guy named Ed Slott. She's also a frequent contributor for various meetings that he does. She's a guest speaker at his meetings, as well as his IRA advisor. She's a guest expert in IRA advisor as well. And she contributes to this little newspaper called USA Today. So Heather, absolutely thrilled to have you. Now, to kick this off, tell us a little bit about recent history. What has happened? And most importantly, what should we be leveraging based off of what has happened here recently? And again, folks, ask questions as we go.
Well, I'll say what hasn't happened in the last 15 months. I have had so much job security because of all of the tax law changes that have come as a result of COVID, before COVID. But, you know, I talk to financial professionals, Charlie, you and I talk all the time, and the things that have really been top of mind are things like I call it rest in peace stretch IRA, right? That was one of the things that the Secure Act finally put into place. It had been on the chopping block for quite some time that they were going to eliminate the ability for mostly non-spousal beneficiaries to stretch over lifetime. People really used it. Financial professionals, tax professionals really touted the benefits of using qualified and pre-tax assets to stretch and do and with legacy planning, because that tax deferral would continue to grow over sometimes 80 years if it was a grandchild. So that finally came to fruition, and the Secure Act all but eliminated the stretch, except for a few newly coined eligible designated beneficiaries. And I'll talk about that quickly because it's been a year, but I still get tons of questions about it, which is why I'm starting with that. But they eliminated the ability to stretch over a lifetime and instead require an accelerated 10-year rule.
So Heather, I think we all know about the stretch IRA, but quite simply what the stretch IRA was is if my dad passed away and passed on an IRA to me, I can keep that in tax deferred status forever for my lifetime outside of a tiny required distribution. It's tiny because I'm so young and not really, but my life expectancy, it's based off the beneficiary's life expectancy. So that can remain intact. And that's done for the most part, right?
Right. So that required a pivot. We'll talk about how do you, I'm always looking for when things change and it doesn't look so great, especially when that is something that you lead with. And a lot of financial professionals really led with that as a legacy planning tool. How do you change your conversations? There's always an opportunity with change, and we'll talk about that. But what they did was they replaced it with there's all kinds of, there's a non-designated beneficiary, designated beneficiary. Now there's a new coined term called eligible designated beneficiary. And these are the folks that are lucky enough to be grandfathered into the pre-Secure Act ability to stretch. So the one that continues to retain the same options as before is obviously a surviving spouse. Surviving spouse can move into the shoes of, step into the shoes of, transfer an inherited IRA, or rather an IRA of a deceased spouse to his or her own. That's one. So they really aren't affected.
So if I pass away, my wife can just take over my IRA without cashing it out because the IRS wants you to cash it out quick, right?
That's the whole point of eliminating it. It was, the logic was this isn't here to be a tax shelter for beneficiaries. It was accrued during the lifetime of one person, so now you got to get it out of there. Surviving spouse still has the option. Chronically ill individuals still have the option to stretch distributions over a period based on their lifetime. So eventually it's all out. Disabled individuals, minor children, and the thing with minor children is hopefully no one names a minor child outright. They have a custodian or something, but they're only an eligible designated beneficiary until they reach the age of majority. So that's usually 18. Once they reach that, then they've got a 10-year period to get it out. And the final category is individuals that are no more than 10 years younger than the decedent. So that could be anybody. I had one the other day where it was a brother that inherited from his sister. He was only 7 years younger. So instead of taking that accelerated 10-year rule, he can effectively start taking distributions. She died this year. Start taking annual distributions based upon a period of time based on his life expectancy and go forward. That was his choice. Everybody else falls into this 10-year rule. So it essentially looks a lot like the 5-year rule in terms of not requiring an annual distribution every year, just that it be out by the end of year 10. So from a planning perspective, if we haven't had time to kind of pivot to maybe more tax-friendly vehicles and someone's sitting on an IRA of $500,000 that someone's just inherited, that's a problem because you've got basically, if you're a grown child, for example, you've got 10 years to get it out. You don't have to take anything out from in years 1 through 9, despite, if anyone saw it recently, the IRS finally published the 2020 IRS Pub 590B and A, but B. And so we were all practitioners. We're eagerly looking at how they interpreted these rules from the Secure Act, and they botched it big time. They had an example in there that said it was a father who had died, son inherited it, and it said in years 1 through 9, you go to the life expectancy tables, son, take an annual RMD, and then at the end of the 10th year, whatever's left, you take it out. That was not the way it was written.
Just to be clear, so let's expand on. So just to be clear, so this new 10-year rule says, okay, Charlie's dad, let's say, Charlie's dad passes away. It's after January 1, 2020, if I remember right?
Yep, December 31st, 2019, yep.
Anybody that passed away after that, it is okay, you have to cash it out within 10 years. So 9 years, 364 days from now, we thought you don't have to do anything until then, but then you cash it all out,
Right.
which that gets the IRS their money quicker than what the old stretch used to be, right?
Right.
So what you're saying is that is or is not the case.
That is the case. The IRS wasn't speaking to the other arm of themselves or something. All of us were like, what is, it was like someone was really, I mean, I hate to say they were smoking something. So we all got together, we all noticed it. And so right now, the IRS has verbally said it's an oopsie. They have not changed the publication. So what I would say is if you have read about it, know that the Secure Act, the intention of that change from life to 10-year was to treat it just like the 5-year rule used to be, which was we don't care what you do in years 1 through 4, or in this case now 1 through 9, just get it all out by the end of the 10th year. So I would say if you have clients that ask about it, you say, you know what, the IRS hasn't formally come out with the oopsie recovery yet, but they have verbally said they acknowledge that it was a mistake. So I would say, if someone says, oh, should I take an RMD? I would hold off because we expect
Okay.
additional guidance from them before the
So
end of the year.
here's an important point. Agents have come to me over the years and have said, hey, prior to 2020, these new rules, or prior to December 31st, 2019, it was, hey, client passed away, they're passing it on to their beneficiary. Who takes a stretch IRA? What carriers in the annuity world? A lot of them. Is that the case now because of that 10-year rule? Somebody passes away, Charlie, the beneficiary has to cash it out within 10 years. But what happens between now and 10 years? Do
Right.
carriers take that?
It's a challenge, I'll tell you that. It's a challenge because at the very beginning when this happened, a lot of carriers had this sort of knee-jerk reaction of we're no longer taking any death cases where it's not a spousal beneficiary. That was sort of, and some of them changed their tune to say, we'll take for deaths that occurred prior to 2020 because those are not under these new rules. So we'll take those. Some have uniformly said we're not taking any. But you do have a handful of carriers that have said, you know what, this is an opportunity. And you asked, what could carriers do? I'm like, leverage these opportunities. I said it from the very beginning. I said the smartest carriers will be the ones that create a product that is within the confines of the tax law, but allows someone to take that money from carrier A to carrier B as a beneficiary and take the 10 years that they need or want, right? Um, we haven't seen as many that I would like to. More have come back and said, okay, we'll take a grandfathered one. But a lot of that, I think, is because the rules are complex. I mean, this is, again, job security for me. And so some of them, if they're not really in the space or if they don't have somebody on staff that is truly an advanced markets person or whatever, then they tend to say, no, we're not taking any. So it really depends. So that's always the caveat I have when I'm dealing with someone who's passed and the beneficiary is not an eligible designated beneficiary and has really essentially the 10-year rule. I'm saying, okay, our first challenge is to find the product that will take it. Now, going back to the accelerated 10-year thing, now, if we're dealing with pre-tax, if we're dealing with a large pre-tax balance, does it make sense to take it all out in year 10? Probably not. Because what's happening is now you've got, 80 and 75, 80, 85-year-olds who are their beneficiaries. Their surviving spouse might be, or their spouse might be deceased at that point. They're probably giving this money to their children who are in their prime earning years likely. So is it great to have a 10-year, a hit at 10 years? So, if it's pre-tax, I'd say consider taking it out piecemeal so that it's not a huge shock to the system. If it's Roth IRAs fall into the same rules, only the taxation is different. So if it's a Roth, I'd say, heck yeah, you let that sit there until the end of year 10, because guess what? It's all tax free. So all that 10 years, you're getting that tax deferred growth that's never going to be taxed. So it's sort of how's the tax play going to be? And it, is usually what I suggest that people consider to avoid that huge, yucky tax bill at year 10.
So that's interesting. So a few points, right, to kind of summarize. First of all, there are carriers that within the 10-year period will take it. I know of like 2 or 3. They say you cannot have a product with any longer surrender charge period than 10 years, obviously. I think these are actually 7 years of carriers that I'm thinking about their approved
Yeah,
product.
right. 7 or 8 years, I say.
8 years, okay.
Yeah.
And then number 2 is for pre-tax money, it may help to systematically take a little money out instead of being in that massive tax bracket later on, right?
Yes.
Because of the shock to the system. But with Roth, that's interesting. Maybe wait until the end.
Yeah, I mean, definitely. And if you're talking about somebody, I could go on and on. We could do this for hours, but if you're looking at somebody that's like, let's say they're 63 and above when they're inheriting this money, you got to be careful. If they're inheriting a sizable IRA balance, you got to start thinking about Medicare premiums. And so if you have a huge hit in 1 year and it takes you above, this year it's $176,000 in 2019 will determine your Medicare premium. If you have above that, you start paying an income related monthly adjustment amount. So it's kind of all has this ripple effect that you need to think about when you're working with your clients. Like, how old are they? How is this going to affect them in other areas? Obviously, Social Security, taxation, and all of those things. I could go on and on. But so that's the challenge, is the carrier part. Where's the opportunity? Well, the opportunity is be the one out there pounding the pavement, making sure people know. You've got tons of people, I see them every day, that have the largest assets they have besides their home is their qualified plans or IRA rollover accounts. It's like, they need to know what's going on. If they've
Isn't
got
it,
time.
isn't that
What?
amazing? Yeah, with the exclusion on the estate tax going way up, what, like almost 12 million
Yeah.
a person? I hear people all the time, oh, GUL, perm term base. Oh, it's dead because the estate tax, is not as intrusive as it used to be.
Hmm.
Really, when we're talking people that are going to get, say, 35%, maybe 37%, 30% of their IRA, which is their largest asset, gone to the
Yep.
IRS,
Yeah.
still
Bye-bye.
no life insurance to offset that tax liability. So
Yeah.
there's more to it than estate tax.
Yeah. So, right. So where can you pivot? If you were a person that really kind of touted and encouraged people to consider this as a legacy planning tool, there's two ways, right, to get tax-free death benefits. Roth conversions, which, I'm all for Roth, because death is your qualifying event. And as long as the account's been held for 5 years, that's tax free. And cash value life insurance that can have, multiple uses. So it's like, it's like life insurance to me has been sort of in the dark a little bit because we had this stretch IRA, but now it's like, okay, we don't have that anymore. So how do we pivot and how do we make this attractive? So if you're dealing with clients that have some time, they're not right up at death's door, but they've got some time. You can say, hey, what about pivoting? If legacy planning is truly important to them and they are concerned about the tax liability to their beneficiaries, and those are the ways to transition the traditional IRA qualified plan balances to make them more tax friendly legacies. That's what I would say to that.
I was thinking of an idea, and it's in the whole vein of with IRA or 401k, you're in partnership with the government, right? Except uniquely, the government can increase time. I thought of many times we ask for statements from our consumers, like a 401k statement. What if you cut that statement in half? And as you're talking with a client, okay, as we talked about in our last meeting, here's your 401k statement. Well, but why is there only half of that? Well, Mrs.
That's what
Client,
you're
because
going
you
to
only
get.
own
Right.
half. I
Right.
mean, maybe a little gimmicky, but I was thinking about that the other day. Oh, well, you only own this half of it, so that's where the other half is. So there are probably some ideas that the audience can take further from there.
Yeah, it's a scary proposition. So what other
Yeah.
things changed? Obviously, the RMD age changed, increased from 70 and a half to 72. The Secure Act 2.0, which I think we'll talk about in a few minutes, is even looking at changing that gradually to 75. Where are the opportunities there? Well, the opportunities is more time to shift assets from point A to point B, meaning, shift it to life insurance. You're going to have to pay the taxes to do it, but we're looking like we're going into a higher tax rate environment right now. I've said taxes are on sale, at least at the moment, until 2026. So it is a good time to consider repositioning I always say from a tax bucket standpoint, is there a way for us to do we have more time before we're forced into RMDs? So is there time to do it? Again, if you're at 65, got clients 65 plus, or even 63, because Medicare premiums are determined 2 years before the actual year. So really at 63 for people who are going to apply at 65, need to be thinking about that. So you just have to be forward thinking, okay, how can I use this to my advantage? A year and a half of extra time to not have to take an RMD is opportunity. What else changed? The waiver of RMDs, I've been asked this a lot. They waived the RMD requirement last year. That did not extend to 2021, at least yet. I have not seen anything on that. People have also asked, what happened to the life expectancy tables? They were supposed to change, and they indeed were. They were supposed to go into effect in 2021, but COVID took care of that, and they got pushed back. So in 2022, this will be fun too. We'll have new life expectancy tables. it'll be fairly easy for people that are just own the accounts, but people that are grandfathered into those stretch rules it's a whole nonsense thing that they have to go through to recalculate RMDs. That's fun. We'll have another webinar on that. But that's coming. What else have I been asked about? Oh, let me just say this about non-qualified annuities. So the Secure Act, for all intents and purposes, for most adult beneficiaries, non-spousal, accelerated to 10. Non-qualified annuities were specifically exempt from that legislation, which means, especially with the possibility of the step up going away, non-qualified annuities just got a good boost, at least for now, meaning if someone has non-qualified money, they still have the ability, non-spousal beneficiaries have the ability to stretch over a period that doesn't exceed their lifetime, as long as they start taking distribution within 12 months of death. It's not 1231 like IRAs are, it's within 12 months. That's pretty big, because I've heard just most people have assumed, and many financial professionals I've talked to have said, oh yeah, well the non-qualified is the 10-year rule too, and it absolutely is not. So at least from that standpoint, hopefully they'll just fly under the radar, and that will be one place where, you know, that would be a good legacy planning tool if someone has a large non-qualified annuity.
And that's the same beneficiary tables as what the stretch IRA used to be, and eligible designated benefit. Okay,
Yeah,
so the same
so you only look at the life expectancy, single life expectancy, the year after death. You look at it one time for a non-spousal beneficiary, whatever that is. Suppose it is 32.2 years, then you reduce it by 1. So you've essentially created a 32-year period certain, but it's based on life expectancy. But they have that period of time. Of course, they can take it, you know, faster than that, but they're still able to. So I did want to point that out, because a lot of people assume that it automatically applied to non-qualified. Okay.
Everybody that I know that we've talked about this with, the non-qualified thing, yes, they believe that it's in the same bucket as the qualified. You're right.
Yeah. Well, some of them don't even know that you can stretch it. So you know that you can. So that one I wouldn't be as worried about as I am with the clients that have huge pre-tax buckets of money sitting around.
I was going to ask you, you mentioned Medicare. We haven't gotten into Social Security or anything. It's not really on the docket. How does one get access? I mentioned the newsletter earlier, because you do talk a little about Medicare in your newsletter, right?
Mm-hmm.
How does one get access to that before we move on and I forget about asking you?
Yeah, so you can go to my website, HL like Larry, Sam, HLS, retirementconsulting.com, and it'll take you to where you can subscribe to it. And yes, I talk about a variety of topics. You know, I was telling Charlie earlier that this month I went deep into the family maximum rules for Social Security, retirement, survivor, and disability benefits. They're not all calculated the same, but just really, to me, things that I hear about that, you know, I write the newsletter from the standpoint of what do I need to impart to you to elevate your confidence in talking about it, and how do we translate that into an opportunity. So I think that's how the newsletter is different than a typical techie, nerdy, which I am nerdy and I admit it, I own it, but I do translate it to, okay, how do we translate this into bringing value to your client relationships so that you can get more clients and more sales. So anyway.
You have always done that, not just about the tech stuff, but yes, what does this mean to you? Which is what, call us selfish, but I think that's what most financial professionals are interested in.
Well, and people tend to run under their desk when it comes to talking about Social Security and Medicare in some ways. It is complex. You're not supposed to be a Social Security expert, but what you want to do is have enough confidence that when someone says, well, what should I consider before I file, you don't hide under your desk. And so that's kind of what it's intended to do.
Hey, folks, in that vein, 2 questions for you, and you can answer this. Number 1, would having Heather involved with Social Security planning strategies, whether it's webinar, whether it's white papers, I don't want to over volunteer you, Heather, but let's just say anecdotally, would doing something in the vein of Social Security planning strategy training, is that something that should be a part of the Retirement Academy? Yes or no, or indifferent. So down there, lower right-hand side, yes, no, or indifferent. Yes, yes, yeah.
And I can't see what you're saying, so you can say absolutely not. She would put me to sleep and I won't see it. So, but it is my love language, and I do have fun with it. I talked about it for 3 hours yesterday in a live virtual event, and no one got off the phone. No one got off the event until the bitter end. So
somebody said here, yes, especially Medicare. So heads up there that Medicare is a big deal. Healthcare for the older. Now the second question is, Any questions on the content so far? I have 0 questions so far. Any questions at all before we move on past the old stuff on to the future stuff here? What is planned, what is happening, and what are the opportunities? Any questions so far? Again, ask questions. You guys know how to do that now. Ask questions as we go here. It's not about me asking questions, it's about you. You hear enough of me. Anyway, Heather, so looking forward, what is happening and what are the opportunities? Quite simply, what's happening and what should we leverage?
Lots happening. I'll tell you, just since we're on sort of that Social Security thing, one of the things that the new administration has talked about doing, and I think probably could come to fruition, is, because we have the Social Security trust funds are going to be depleted by 2035 if nothing is done. That report in 2020 did specifically excluded any effects of the COVID-19 pandemic. So that means it's probably more like 2034, 2033, because what happened? Nobody was working, and so the payroll taxes weren't going in. So the new administration has talked about sort of having everything is kind of focused on people that make about $400,000 or more, sort of taking the brunt of these tax changes that could come to pass. And so his suggestion would be have a period like if there's a taxable wage base, right, where your income up to the 142,800 this year is taxed, Social Security tax. He's suggesting that beyond 400,000 would pick the FICA tax up again. So that's one way he's suggesting, and I do possibly see that happening because people are always panicking. Oh my gosh, my clients just want to go pull the trigger because it's not going to be there. I think it's going to be there. I think it's going to be in the form of higher payroll taxes, though, not the pullback of benefits from people close to or in retirement. I really don't think that he would say, oh, Mr. Senior Living, I'm going to cut your benefits. It's just not going to happen. In fact, he's quite the opposite in what most of the suggestions that he's making would actually cost the system a little bit more, because he's saying, hey, if you've been in the system for 20 years, you'll get a 5% bump over a number of years. We're going to eliminate the weapon GPO. There's all those kinds of things, but that's the one that he's been consistent on and could pass for high.
So that's the donut hole that we're talking about, right?
Right. So you'd have a period of income where you wouldn't pay it, right? Yep. And then a 400,000, they'd go up again. Now, Medicare taxes apply to all income, but Social Security has a limit. So that's that. What other things are coming down the pipe? The capital gain rates. So the American Families Plan, which is part of the Biden's tax plan, is 1.8 trillion in cost, it's estimated. So of course, where are we going to pay for that? So one of the proposals is to increase the capital gains rate up to 39.6 for incomes of $1 million or higher. So again, focused on the top 1% of taxpayers, but it would double the current highest capital gains rate from 20% to 39.6. Then you add the net investment income tax, so that's another 3.8. So it could be, what is that, 43.4% in total. Who's going to pay for this? Obviously the top 1%, but I'll use my dad as an example. He's getting ready to sell a very large business, and he called me panicked. And I said, well, you better hurry, because if this happens, he could retroactively go back. If it happens this year, he could retroactively go back and say it's effective 2021. I sure hope not. I suspect that these changes, if they come to fruition the way they are, will take some time. I think there's going to be some tweaking of some of these provisions, but that's a serious, for a business owner that's looking to sell, that's, been successful, that's an issue. Obviously the individual taxpayers too, but again, it would affect those at $1 million up. The other big one, income tax rates, taking it back to the top rate. Now the top rate is 37%, taking it back up to 39.6. Right now we have these tax rates scheduled to expire in 2026 to go back to the old. It could be sooner. Eliminating the step up in basis. So the step up in basis rules, if you're not familiar, means that if I purchase, a home or a security and my basis in it is $50,000, and by the time I die, it's worth $250,000, the step up in basis rules allows my beneficiary to now have a basis that is the date of death value. So all of that gain, that $200,000 in my example, is never taxed as a capital gain. He's looking at eliminating that entirely. That would be a huge the difference, right? When we talk about legacy planning, I've always said the pro of an annuity, the non-qualified annuity, is the tax deferred growth. The downside of a non-qualified annuity is it's taxed as ordinary income compared to a stock, a mutual fund, a home that gets the favorable capital gains rates, which right now 15% for most, 20% for the highest taxpayers. Well, that would change. If he eliminated that, that would be huge, and it would be taxed to death. So that's a huge one. I don't know. I mean, I don't have a crystal ball, but I don't think it would pass in current form to just wipe it for everybody, maybe at a certain income level. What else? Corporate tax rate. So we got a reprieve from the highest corporate tax rate, which I think was 35% before. I don't even remember which act it was now that changed it to a flat 21%. The new administration would take it back up to a 28%. You know, again, I always look at business owners. Small businesses are the bread and butter of our country. And so to do that, I think that could be an issue for corporate
Here's a
taxpayers.
question. In that vein, do you think this will trickle down to middle income eventually in terms of higher tax rates? So I don't know if he's asking about the actual tax rates or will it trickle down. I guess maybe you can give your opinion on both.
Yeah, I mean, I think that there's no way. I mean, well, I say there's no way because I don't have a crystal ball, but I think that it will trickle down. I think that the tax rates will probably change upward for almost all categories. I think, though, that the bulk of this is designed to affect the top 1%, but I don't think that regular, lower and middle class and upper middle class taxpayers are not going to be scathed. I think that everyone will see an increase because there are a lot of things in the agenda that are going to require money. And that's the only way. That's the only way to get it, is to raise taxes.
Awesome. Awesome.
What else did I miss? Estate tax exemption. That's another one. That's not set in stone as far how far down it would go. It's 11.7 million now, double that for married couples. In 2026, all of these tax cuts are expected to expire. The estate tax would go back to 5 million. There's some murmurings of it going to 3.5 million under Biden's plan, but it's too soon to tell. And these are all things, again, focused on the highest taxpayers. Whether they go through in this form, I doubt it. I think that there's going to have to be some compromise because I don't think he has bipartisan support by any stretch of the imagination.
Heather, and I think it's easy for a lot of people in not necessarily in our business because we all take this serious, but for the average consumer to blow it off as in, well, it's a maybe, possibly, he could do this. If nothing happens, things are going to change in the beginning of 2026, assuming nothing happens, let alone the bold initiatives that we have planned, right?
Yep. Yeah, it's hard. I mean, I've been saying for years, taxes are on sale right now. Taxes are on sale right now. So now's the time to repivot to go. If you're not insurable, do a Roth conversion. Start that ball rolling, because the last thing you want to do is not know in retirement how much how much of that qualified plan or IRA you're going to have to spend, because we don't know what taxes are going to do. But yes, if nothing changes, which I think things will change before then, but 2026 is when we would go back to.
She'll be back.
Sorry.
No, I figured that's what happened.
Sorry, but by 2026, we know it will. I think that there will be changes before that, but it's hard. Like when you're planning, I was talking to a guy that was dealing with a high net worth client the other day, and I'm like, well, here's the what ifs. If you want to secure the higher estate, unified, gift and estate tax exemptions, what do you have to do? Do it now, gift it while you're living, because until it changes, you've got the higher rates. If you wait until death, then you're taking a gamble for the people that really are in that category of having that type of wealth. So it's hard when you're sort of right in the middle of all of these proposed changes, not knowing what it's going to do, not wanting to put clients on a panic bus, but being smart about trying to at least diversify from a tax standpoint so that we're not laying awake at night saying, how much is Uncle Sam going to take of this when I finally start taking my RMDs, or whatever the case may be.
There is another opportunity that we haven't talked about, and it is, okay, well, if you have a client that maybe not 15 years from now, but rather 10 years from now has that horizon, or 5 years from now has that horizon. The changes to section 7702, which allow for you, so taking Heather's advice and moving some of that money to Roth IRAs, moving it into cash value life insurance, section 7702, the changes effective now have made it possible so life insurance, in order to have a benefit when it comes to taking tax-free distributions, we're not talking 15 years from now. We're not talking crossover points to where, okay, the premium that you put in, the client will be able to get that back in, oh, say 11 to 12 years. What you're going to find is with these increased funding allowances that are as a result of the changes that happened at the beginning of the year, you'll find that you can move up a little bit, or you can talk with clients that have a shorter time horizon than maybe what you did before when it comes to funding life insurance, letting it bake, and then taking distributions out. So that's a heads up, and that is kind of a byproduct of all of this. But section 7702 is something you should be familiar with as well, in which we talk about, of course, a lot in the Retirement Academy. Another thing before I forget, whole life insurance, kind of a fire sale this year on whole life insurance for the most part, because standard non-forfeiture laws are requiring that they reduce their guarantees in 2022. And that guarantee is, if it's 4% today, has to go down to 3.75 or lower. If it's 4% today or 5% today, 3.75 or lower. They cannot guarantee any more than 3.75 on whole life. So keep that in mind as you implement the stuff that Heather's talking about here. Sorry, Heather.
That's okay. You know, the other thing I was thinking about, it just popped in my head that we were going to chat about, was qualified charitable distributions and charitable donations in general. I didn't mention that as a look back thing, but we really should be talking about it from a tax perspective. It's been several years that we got the qualified charitable distribution added to our chassis of things we could do to mitigate taxes when we're subject to RMDs. What the qualified charitable distribution is, if you don't know, and you absolutely should know, is someone who is 70 and a half or older, who has a traditional IRA ideally, who is already contributing, whether they're donating to their church, whatever they're doing from other sources, they should pivot to the qualified charitable distribution strategy. The reason they should is because at 70 and a half or older, incidentally, it used to align with 70 and a half being the RMD age. They separated in the Secure Acts. RMDs were increased to 72. QCDs were kept at 70 and a half, but they can transfer directly up to $100,000 into a qualifying charity, not get a charitable deduction. It's tax-free. When you get to the place at which you're 72 and subject to an RMD, it also satisfies the RMD up to the amount that the qualified charitable distribution. Don't have to do 100,000, but you can do up to. It's only at this point traditional IRAs, Roth IRAs, but you wouldn't want to do it from there because that's already tax-free. But what I would say is everybody that's that age that is trying to get enough of a charitable deduction to bypass the standard deduction, which a lot of people aren't. We were talking about how charitable donations have probably gone down significantly because of the doubling of the standard deduction. So a lot of folks aren't, they're donating all this, they're not getting a tax effect from it because they can't bypass the standard deduction. With a qualified charitable distribution, you don't have to itemize because it is tax-free. So they should be doing that. That's much better than any deduction could ever be, tax-free. So make sure that anybody that you know that is charitably inclined, that is looking to mitigate taxes, particularly when they get to RMD age and want to avoid having that tax torpedo of an RMD, $100,000 up to $100,000 a year, has to go directly to the qualified charity, cannot come through the IRA owner's hands, has to be made payable to the charity. Some carriers are still sending it to the IRA owner, only made payable to the charity. That's the big deal. The other thing that I just read, we're not there yet because I think we're looking forward to get to Secure Act 2.0. People ask, can you do a QCD to a charitable gift annuity or a CRT? And the answer has always been no, it doesn't work that way. So in order to get it from that point A to to a charitable gift annuity or CRT, it's taxable. There is going to be, if Secure 2.0 passes, there is a one-time offer to allow 50%, up to 50%, so 50,000 in 1 year to go to a charitable gift annuity or a CRT. So that's been a change from how it's worked in the past.
So the qualified charitable distribution, and there's a video on this in the Retirement Academy. This is cool, right? Because the way that charities usually work is, or charitable deductions work is, you have income up here above the line, you have the income, right? And then what's deducted from that income depends on, do you standard itemize deductions? So do you itemize your deductions, or do you have a standard deduction? Many people have standard deduction. They take the standard
Most,
deduction route
most
because it's
taxpayers.
massive, right?
Right.
So therefore, and by the way, that charitable contribution is not incorporated into this. It's incorporated only this over here. But the difference is now this and this don't matter. It's just that the qualified charitable distribution is not even included in your income, even though you effectively cashed out that chunk of the IRA. So it's an above the line thing versus below the line, and that's a great thing.
And it satisfies the RMD up to that amount that you, so that's a big deal for people, particularly like looking at like, oh my gosh, I don't need this money. What do I do to, it's going to bump me into a, Medicare. I mean, there's all kinds of whole host of things that could cause. So, and now there's a whopping $300 above the line deduction for charitable donations if you don't itemize, $600 for married couples. Woo. That's all you get though. So it is
So
really
things,
something.
Heather. Heather, I am co-writing a book and would like to talk with you. Sending a contact request on your website. So heads up there, you're going to get,
okay.
well, Heather rocks. That's the other one. So I guess I don't have anything other than great compliments for you.
Thank you. Thank you. Are you sure you're not just making that up? Because I can't see what they're saying.
I promise I'm not. I promise. Anything else in this area before we move on to the last section and then have them fill out the evaluation, then we're done. Anything else?
I think that I've probably, hopefully no one's gone into a coma, but it's always opportunity. I'd say, we just sit and wait at this point. I don't think that all of these new agenda items will go through as is. I think there's going to be a battle as to how much, and it happens, but I look every day and, we'll keep you updated. I'll come back and we'll talk about any changes.
Here's a question that just popped in. Is your newsletter for beginners or advanced guys and gals?
No, it is for people that really want to gain the confidence to talk about Social Security. And let's face it, you got to be talking about it. I mean, if you're saying, oh, go talk to your CPA, the CPA is going, please don't ask me, because they're the ones subscribing to it too. So I really try to make it, one of the things that I've always gotten a compliment on is that I try to, and Charlie, maybe you can attest to this, I really try to take very complex information and dial it back to where you can get it, and I use a lot of examples. So I think, it's going to give you more than just reading on the Social Security website, but I have all kinds of people, beginners, intermediate, advanced, all kinds. CPAs are doing it because CPAs, are the ones also, they're supposed to be the shell answer man or woman about everything. So I just find I've gotten great positive feedback on it. You can certainly remind me if you want to just see a sample. I will send a sample. So send me a request and I'll send you a sample. Or maybe I can send it to you and all the attendees. You want to do that? All the attendees that are.
What do you prefer? Do you prefer they send you directly, or do you want me to collect them and send them to you?
It's up to you. It's fine. Either way.
Folks, send them to me. Send them to me. info@retirement-academy.com. Send them to me, or send your name to me saying you want it. I'll send it. And I don't know, Heather, how we can deal with the logistics on the back end.
Or
Heather,
you can go on my website. Either one, whatever you want to do. Okay. But I always like to let people see what they're getting before they subscribe to anything. So.
And before we move on to the next section, if you're not a member of the Retirement Academy, it's retirement-academy.com, retirement-academy.com. This will probably be the only webinar because it's the first one where I open it up to non-members. Obviously, I want to be cognizant that the members are paying something to have the exclusive material. So, if you want to join the Retirement Academy, retirement-academy.com. Heather. Okay, so given all of that, we have on the phone agents, we have IMOs that recruit agents and train agents. We also have, I don't know if we have any carriers on the phone today, but certainly they will hear this recording because we have carriers within the Retirement Academy. For each of those, what are the biggest opportunities that they should take advantage of to differentiate themselves from their competitors?
One word, and it's education. I am all about, as this is why I love this retirement academy, because what is missing, it's not the bells and whistles to attract, I mean, I know it is, but to attract producers to IMOs or whatever, they need education. And being able to not look like you've just seen a ghost when someone asks you about some recent legislation or what could happen or whatever, it's important for financial professionals. So I'm a big advocate of being your own advocate by, signing up for Retirement Academy, listening to these types of webinars so you are familiar with what's going on. Same thing, IMOs, to me, education is where you're going to differentiate yourselves. And with carriers, again, we talked about you leverage these as opportunities to design products that align better with, what the changes of the ebb and flow of tax law.
Beautiful, beautiful. Any other questions? There's no reason for me to belabor it. By the way, stick around, folks, please, and fill out the evaluation. Tell us how we did. Any questions? And then I'll see if Heather has one last thing to add before we go. I'm going to give it about 10 seconds. And if there are no questions, we'll get Heather's final commentary. And then please stick around and fill out the evaluation. That's probably about 8 seconds. Well, now 10 seconds, right, Heather? So no questions have come in. Heather, any last comments before we close out and do the evaluation?
Yeah, I didn't mention the Secure Act 2.0, which is really called the Securing a Stronger Retirement Act of 2021. It's kind of going through the House Ways and Means Committee right now. There's some changes you may have heard, increasing RMDs to 75 over a number of years. I could definitely see that happening. Allowing higher catch-up contributions in 401ks and simple IRAs for people between the ages of 62 and 64. I guess they're assuming right before they retire. What else? What else have we read about? Indexing the IRA catch-up contributions at 50 plus. They've never been indexed. They've been a flat 1,000.
Accounts less than 100 grand, Heather. I just read something about that accounts less than 100 grand, there supposedly could possibly be just an exemption with RMDs.
Yeah, you read that. I hadn't read that. That doesn't mean it doesn't exist.
No, that's what you told me, Heather.
You told me.
She says, hey, I take no responsibility for what Shelley did.
It makes sense, but it doesn't, because the point is trying to get as much tax paid as possible. So who knows? But it's always, there's the shift in tax policy has been this way even before the new administration took over, to give people approaching retirement more opportunities to save for themselves. Automatic enrollments, making part-time, long-time employees eligible for 401ks is coming down the pike. So there's all of these things that are sort of saying, hey, you can't rely on Social Security for as much as you would like to. You need to start taking ownership of this. And so those things, I think, are positive changes, because at the end of the day, people are relying on Social Security for far too much of their income. And if they're not talking about long-term care zaps a ton of it if they don't plan for that either. That's a whole nother conversation. So good changes that, might not be great for everybody, but until it happens, we don't, you just got to be aware of them and talk your clients off the ledge if they're concerned.
Heather, we're going to have you back. I think it's almost unanimous. And at this point in time, we will close out. You guys can do the evaluation. Tell us what you think. Give us your honest feedback. Also, tell me how I can make the Academy better. That's a question in there. Heather, really appreciate everything. Thank you for your time.
You're welcome. It was a pleasure.